And I would like to start by introducing Mr. Ángel Ubide, who is co-director of Global Economics at D.E. Shaw & Company and senior fellow at Peterson Institute for International Economic. He will take the pulse of the Spanish economy and will review the major macroeconomic indicators. Ángel Ubide is an expert on central banking, finance, macroeconomic policy, and European affairs. Dr. Ubide, worked for more than a decade at Tudor Investment Corporation, a multi-strategy hedge fund management firm. Before that, Dr. Ubide served as an economist at the International Monetary Fund and as an associate at McKinsey & Company. Welcome, Mr. Ubide, please.
Thank you very much. Thank you to the U.S.-Spain Chamber of Commerce for this invitation. I want to remind everybody, a year ago, I was doing something very similar with the Spanish Council of Competitiveness at the ES offices here in New York. And we were at the time talking about whether there was a change in the sentiment towards Spain or not. And at the time, it was complicated. We were trying to change the narrative that was at the time about Spain, essentially a country that cannot reform and cannot recover competitiveness, and that if you just read the Financial Times and the Economist, you would be convinced it was doomed. I'm glad to say that some of the things I said 12 months ago were right, and that what the economists and the FT were saying was less right. And what I'm going to try to do now is take you through a walk of what the Spanish economy looks like right now, and all the very difficult challenges that are pending. Let me just say that the one thing that the ambassador, the minister, and the previous speaker have not said is that we still rule in soccer, and 3 of the 4 teams in the Champions and Europe League come from Spain, and that I do believe we are going to win the World Cup. So on that, let me start by telling you that this is the picture, right? Last year when I was doing this, we were around here. The interesting thing is that we already have positive growth. It has been a very long recession. It has lasted, depending how you measure it, a couple of years. The good news is that the sentiment has changed. If you look down here at the evolution of consensus GDP forecast for 2014 and 15, I don't think the number matters much. What matters is the direction. The direction is going up. And I think that's the most important thing that we have to think about now. The question is, how complicated is this recovery going to be? Now, when we put it in perspective, we are still below the pre-crisis level. Spain is the thick line in blue. Now, look at Italy, that didn't have a housing bust. So there is a message in this picture that I think it is that, yes, Spain has been doing worse than the euro area. It's been doing certainly worse than Germany. But it's not so bad for a country that had such a major depreciation of the housing market. There were those who argued that the euro had not been worth it. Well, look at it from a medium term. For those of you who cannot see from there, if you put the GDP level in 97 at 100, we are still well above where we were at the beginning of the euro. So it has been an interesting and a positive experience. The question is, how do we take it from there? Now, let me tell you a few things about why I think the recovery is here. The most important thing is that the tightening is over, right? I think when the history books are written, there would be a chapter on it about policy mistakes and about why European authorities allowed such a tremendous tightening of financial conditions to happen. One can tell this story basically talking about events that happen in European policy making. It is interesting that the creation of the EFSF led to an increase in spreads. It is interesting to see the famous Deauville conversation between Angela Merkel and Nicolas Sarkozy was also the beginning of another increase, and how the decision to restructure the debt in Greece was basically the final drop in the bucket. Everything was corrected, if you want, when the ECB decided to finally step in, declared that it was going to do whatever it takes to keep the euro together. And now we are back to around the levels of the bill. So the question is, if that tightening generating a sharp recession, what is that easing going to do for the economy? Now, I can show you a similar picture that is basically looking at the banking sector, right? That's the evolution of the balances of the Spanish banking sector with the Target 2 system, essentially the money that the Spanish banks had to borrow from the central bank because the interbank market was closed. It's essentially the same shape. It got very bad, it has got better. Now, for those of you who worry that it's not coming down fast enough, remember, the total amount of that is determined by the ECB. So for as long as there is excess liquidity in the system, there is going to be balances there, unless the banks decide to repay every single euro that they have borrowed from the ECB, which is not really economically smart. So this is going the right direction. It's in fact going perhaps too fast. It is being driven by the asset quality review that, as you know, the ECB and the European authorities are conducting, and perhaps it's generating a little bit of a tightening of financial conditions that shouldn't be there, but it is going in the right direction. This is, I think, the most important chart, and I think the minister has been telling you the story of why. Nobody believed that Spain was going to be able to have an export sector, that it was going to be as vibrant and positive as it has been. If you look at that chart, the red square tells you the evolution of exports between 2007 and 2012. The blue line tells you the evolution of import demand of the trading partners. So if the red dot is above the blue line, it means you've been done better than you were expecting to do. And vice versa if your red dot is below the blue line. That essentially means that the Spanish export system and the Spanish export sector was very competitive before the crisis came. They were just focused on something else because the demand was at home. As the commissioner has told us, we are leaders, or Spanish firms are leaders, I don't belong to them, in infrastructure and many other services around the world, and that shows. So essentially what many of these firms did was, when the business ended in Spain, they just went and did it somewhere else. They were ready for it. If you look at this chart, this is the contribution to GDP growth. Imagine if the green line, which is the external sector, had been 0. That would have been GDP growth, -4. Thanks to that, GDP growth was less than -2, around -1.5. That's the key. Sorry, let me just, for you. That was the thing that not many people believed it was going to be possible. Now, one of the reasons that was possible was essentially because, yes, there was also a competitiveness issue that was fixed. This is the Index of Competitiveness that the European Central Bank has constructed for every single euro area country. It is a weighted index of relative unit labor costs, both intra-euro area and outside of the euro area. And what it shows is that the evolution of this indicator for Spain is now back to essentially the year 2000, so to the beginning of the euro. There has been a recovery in competitiveness. Part of it has been wage moderation, but look at the composition. Around 2/3 has been productivity, which is good, right? Because you cannot sustain wage moderation forever. You cannot compete on wage moderation these days. You have to compete on productivity. And this is the result. As I think the minister was already saying, the recovery in the current account has been massive. This is the recovery during the depreciations and devaluations of the early 90s. This is the recovery today. The most interesting part, I think, is this. According to the projections of the IMF, this is basically sustained, is structural. A big part of it is going to be permanent. And if it wasn't for the energy bill, Spain would be essentially a structural current account surplus country, which is a bit unbelievable. This is the picture of wage flexibility. That shows basically the numbers reflecting the wage increases in collective bargaining agreements. As you can see, they were running in the 3 to 4% prior to the crisis. They are now running at around 0.5 point. And the interesting thing is the difference between these two. These are the new agreements. So this is essentially the wage increases that are being negotiated now. These are the agreements that were essentially rollovers of previous agreements. And for those of you who know the Spanish economy well, one of the main issues that were hampering the adjustment in wages in the Spanish economy was what it's called the ultra-activity. Essentially the fact that if you had a wage agreement going on, there was no agreement between the parts, the agreement continued forever until there was a new agreement. And that introduced a lot of rigidity and a lot of persistence in wage growth. When you are coming from a period of very high wage growth, that difficults very much the adjustment. Now, one of the important things of the labor market reform was that it allowed more flexibility on that. And that has been very important in terms of regaining competitiveness in the Spanish economy. The other point that everybody had many doubts about was whether the Spanish economy would be able to reform. Well, I had doubts too, to be completely honest. According to that indicator compiled by the OECD, Spain, together with Greece and Portugal, are the three countries that have both put in place more reforms and put in place more reforms that were more difficult. And I think that's interesting, right? You know, doing the easy reforms is very simple. Doing the difficult one is not so easy. There have been reforms in many different parts of the economy. Perhaps it's not a coincidence that Spain had an IMF program and other countries didn't. But I think it's important that it has gone along all the sectors of the economy, and they have been able to change many areas that were perhaps too rigid. So this is the past. What is the present, and what should we think about the future? Starting again with financial conditions. Interest rates are still too high. If you look at this chart, this is 10-year interest rates deflated by 10-year inflation expectations, 10-year inflation swaps. This is Spain. This is the UK. This is the US. Those two economies are much more advanced in the recovery, have a GDP growth that is much more robust, they have lower unemployment, and yet they have lower interest rates. This is the euro area. It is still too high as well. It is very difficult to have a strong recovery when financial conditions are this tight. Now, for those of you who like anecdotes, this is Germany. If you look at the evolution of interest rates in Germany, they essentially follow the US. So Germany has been enjoying what I would call a process of quantitative easing. They were just lucky from a political standpoint that the ECB was not buying their bonds. But essentially, the evolution of interest rates has been exactly the same as if the ECB had been doing quantitative easing for Germany, which explains the differential performance, essentially, between Germany and the rest of the periphery. Now, the corollary to this is that the inflation rate in Spain is 0. And frankly, in my mind, this is a problem. Yes, I can tell a positive story that this is good for competitiveness and for real incomes. But it makes the adjustment of fiscal policy much more complicated because a lot of items in the budget are defined in nominal terms. And it makes the outlook for the debt profile a little bit more complicated too. It would be much better if this could be here and other inflation rates in Europe were higher as well. Now, this suggests that there is a very big output gap and that perhaps potential growth is higher than some institutions consider. Right? There is a trick in this chart. If you remember, there was an increase in VAT around here that was masking this underlying decline in inflation. Now that the VAT increase has disappeared, what we have is that we are at 0. And look at services inflation. This is the green line. This is the line that worries me a little. Goods inflation goes up and down with energy prices and with other things. Services inflation is sticky. It gives you the underlying tone of inflation in the economy. Services inflation is down to 0. And that is something that I think it's important to take into account. The fiscal outlook. The fiscal outlook is complicated, but I don't know how complicated, to be completely honest. That's the evolution of public debt. according to the IMF, is going to stabilize at around 100% of GDP. The stability program recently announced shows it coming down a little bit in the next couple of years. But I guess what is clear is that there is very little agreement on what the fiscal outlook is. If you look at the comparison between this line and this line, this is the stability program that forecasts a deficit of 4.2 in 2015. This is the European Commission forecast, just released this week at 6.1. The consensus is at 4.8. Of course, the difference is on GDP growth. The Commission assumes a strong growth because it's assuming that the deficit is not going to be reduced. The government seems to be optimistic on both. The consensus is a bit more pessimistic. We shall see, as they say. It's a question of multipliers. It's going to be a question of what interest rates do. It's going to be a question of what the external environment does. It's going to be a question of whether a tighter policy is good for the debt profile or not. As you know, there is a strong discussion here in the US about that. Just leaving the picture here for you to see that the divergences are clear. If you look at the end of the projections, the stability program has it at 1.1, the IMF has it barely at 3. We will see. This is the bad picture, right? It's the picture of the unemployment rate. We all know that the unemployment rate in Spain is very high. But there are a couple of things I want to mention about this. First of all, as the minister mentioned, there has already been employment growth in the first quarter, and that's the positive news. There will be issues with the participation rate, but the important thing is that employment is being created. The second one is this part here. Traditionally in Spain, you needed about 2% GDP growth in order to create employment. That was in part due to the fact that wage growth was very strong and the rigidities in the labor market. With the labor market reforms, and if wage moderation continues, you can start creating jobs with GDP growth that is barely half a point or even 1%. There is some research by Juanjo Dolado and a couple of colleagues that showed this. And this is what should be happening, that this line here starts coming down, even if it's accompanied by wage moderation. But that is what is necessary. Now, the biggest statistic that everybody talks about in Spain is the unemployment rate for the youth, right? You know the story, 50%, half of the under 25s in Spain are unemployed. Well, let me tell you, that's a red herring, because that number is calculated as the total unemployed divided by those who are looking for a job. When you are under 25, what you do is go to school. So when you calculate the unemployment ratio, which is a number that Eurostat also calculates, which is essentially unemployed divided by the total of people under 25, that number goes down to around 25%, which is still huge, but it's a different story. Now, look at the green line. This is the ratio between this and this, which essentially is telling you that the problem of the youth unemployment in Spain is not of the youth. It's a problem of the labor market. And if you don't solve the problem of the labor market with further labor market reform and more flexibility in the labor market, you are not going to be able to push these two things down. And this is a constant, by the way, in all countries. There is a sort of permanent relationship between total unemployment and the unemployment of the youth, because there isn't anything terribly specific about it. What is bad about the youth unemployment in Spain is that because of the duality of the labor market, the probability of a person under 25 of finding a permanent job 2 years after entering the labor force is much lower than in the rest of Europe. Why? Because it's still very easy to get one temporary contract after another and then be dropped. That is why going to a single contract is still one of the most important things that should happen in Spain, because it's going to benefit the youth and it's going to benefit those who want to learn on the job and want to continue to be in the labor market. Housing has been the big news over the last couple of years. The situation is close to stabilizing. The decline in prices has been around 30%. If you look at the red line, that's about what the experience tells you is supposed to be. There could be a little bit more. I don't really have a strong view on that. Investment in construction has come down to levels that look a little bit more normal than they were, obviously, at the peak, but even below the levels that were before. There has been a big decline in sales that are financed with mortgages, and there has been a big increase in foreign investment activity in the Spanish housing market, as some of you know. So essentially, some people are voting with their money, and they are starting to come back to Spain. The banking sector is the other one. As you know, that was the big part of the IMF program with Spain. There has been a big reduction in capacity. There is a big increase in non-performing loans. Most of that is true, but part of it is also a reduction in the denominator. As you know, that's a ratio of non-performing loans over total loans, and total loans have declined. So that's a number that is big and is worrisome and it's a problem, but it maybe looks a little bit bigger than in reality is. The interesting thing is capitalization. So Spanish banks have a core tier 1 ratio of 10% that is a little bit below the average of Europe if you take Spain from Europe, but they have a better leverage ratio than Spain. So essentially what it tells you is that they have capital, but once we take the risk weights into account, maybe there is need still for a little bit more of capital. And that is something that I imagine that it's being discussed right now during the AQR. Final point, as you know, small and medium enterprises are very important in Spain, and they suffer for incredibly high interest rates. This is a chart that has become reasonably well known. That is the divergence in private lending rates to the private sector in the euro area. Now, there are two elements of this. One is idiosyncratic to Spain. As you know, lending to SMEs is basically relationship banking. And if your banker disappears, then you have no history. And it takes a lot of time to rebuild the history. So what we are seeing is that this is something that reflects the fact that the outlook is weak, and I don't know you. It's going to come down eventually. It's not a question of capital. It's not a question of liquidity. It's a question of time, and it's a question of the outlook. As I think the minister mentioned, credit growth is starting to flow. So when you look at new flows, not at the stock, but at the flows, are already positive. So those SMEs that show good prospects, they are getting credit. But they are getting small quantities, and it's a very difficult and complicated process. And so, just to conclude, I think this is the best summary of what we have seen in the last 5 years, right? We have an economy that was very leveraged. We were hit by a very big shock, and some of the policy reaction was not good. So we can conclude that we wasted part of the euro windfall with an unsustainable housing boom, but not all. As I show in one of the charts at the beginning, the economy is in a better place than it was at the beginning of the euro. There is now a second chance, but the starting point is more fragile. There is some structural damage to the labor market, and the confidence that needs to be regained is there. So in order to continue and to be successful, we need a continuation of reforms in many areas. I just mentioned 3 here, but I think the labor market continues to be the most important one, and any move that can be made towards a single contract is going to be very positive. Tax reform is going to be critical because spending is very sticky and very linked to social issues in Spain and difficult to cut, and a lot of revenues were coming from the housing sector. So it's not clear that the path of revenues is going to be able to match the path of expenditures unless there are changes. And there are changes that can be made, and I'm confident that they will be made. And then the internal market, in order to facilitate the flexibility in Spain, there is a lot of issues that generate price rigidities in Spain that can be addressed. And then obviously the eternal wish, we need an easier monetary policy for the euro area and for Spain. And I think it's important that there is more work towards a more solid euro area. That was part of the problem, and there has to be more work. And my message always to the European authorities is that because money is flowing back to the euro area, don't take that as the euro area has become a perfect monetary union, because it is not yet. You need euro bonds, you need more solidarity, and you need a system that works for the euro area and not just for Germany.